Okay, good morning and good afternoon, everyone. Welcome to our Evaluate Energy webinar on oil and gas M&A, key influences on market reactions to upstream North American mergers. A little bit of housekeeping before we get too far ahead of ourselves here. We would prefer that you drop all of your questions into the Q&A that you'll see at the bottom of the Zoom window there, and we will address as many of these questions as we can in the time that we have available to us. And the session is being recorded, as you've probably noticed there. The recording will be made available on the Evaluate Energy YouTube channel following the webinar, so you can always go back and review it at your leisure. And with that, I think I'm going to hand things over here to Nikki Zenonos, our Director of Evaluate Energy. Take it away, Nikki.
Thank you, Jennifer, and welcome to our attendees who have joined us today. So over the course of this webinar, we'll be looking at the results of an analysis conducted by our team, examining key influences on market reactions to corporate upstream acquisitions in North America. So here's our usual disclaimer, please take note. But to begin with, let me start with a little introduction to us. So Evaluate Energy was founded in 1989 and 35 years ago. It's now part of the Geologic Systems Limited. Evaluate Energy offers global oil and gas data and insights on corporate level performance data, M&A transactions at the asset and corporate level, including renewables, power, and low carbon technologies, and contains corporate ESG information. All of this is elevated by our searchable document library. We are trusted by our global client base of top oil and gas producers, government agencies, financial institutions, and consultancies, and all of our clients are supported by our international team of experts. My name is Nikki Zenonos, and I will be presenting today alongside my colleague Mark Young. Collectively, we have over 30 years of experience in the energy industry with varied interests across M&A, financial performance, and sustainability. So moving on to today's agenda, key influences on market reactions to upstream North American mergers. We are covering this today because corporate M&A activity in the oil and gas industry is still rife. There have been at least 2 to 3 years of rampant activity in the market, particularly in North America. There is often a lot of speculation about the reason behind the effect of the announcement of each of these deals in market, which we will be investigating further today. Evaluate Energy's M&A database tracks all energy sector activity since 2008, and so we have the insight of historical analysis and benchmarking to draw upon, making it perfect for this analysis. Today, we will be discussing the immediate share price reactions to corporate mergers being announced in market and how this correlates to key deal metrics and characteristics, such as how far do traditional purchase price metrics correlate to share price reactions? How important is expanding in a basin of existing operations? How do private company acquisitions compare to public ones? How are different deal structures received? How far do oil prices and debt correlate to share price reactions? And finally, what else might impact share price reactions in future? I'm now going to hand over to Mark, who's going to talk us through our findings using Evaluate Energy's data.
Thank you, Nikki. I'm going to start by setting out some parameters for how we conducted the analysis. So we are looking purely at changes in the share price for acquirers in corporate merger deals 1 day after the deal was announced. If a merger was announced on January 1st, we'd see how much the share price changed on January the 2nd for the acquirer, and we'd log it as a percentage value change for analysis. Today, we're not analyzing what happens to share prices after mergers close, any projected long-term growth from brokers or industry analysis at the time of the deal, purely this 1 day share price change to see if we could draw any correlation at all between these immediate share price reactions and certain deal metrics and deal characteristics. So what did deals with positive share price reactions have in common, and what did deals with negative reactions have in common? Our data here will focus on these 1 day share price reactions for 153 corporate mergers that were announced between January the 1st, 2014 and August 31st this year. Every deal at the time of being announced was valued at $50 million or more, and every single one of the deals see a public US or Canadian headquartered company by another company with US or Canadian producing assets. We've excluded any deals where the acquiring company had zero production at the time of the deal being announced, and we've also excluded purely asset-focused deals, with focusing only on corporate mergers in the upstream sector. So this chart or variations of this chart will appear quite frequently throughout the presentation. It shows each of the 153 deals ranked purely by its percentage increase and decrease in share price for the acquirer one day after a deal was announced. Each individual blue bar you see here represents one deal. So, for example, this deal here represents Chesapeake Energy's merger with Southwestern Energy that closed last week, forming Expand Energy Corporation. And a day after the deal was announced, Chesapeake's share price increased by 7%. In all, the data shows a relatively even spread between positive and negative reactions over the 10-year time frame. So 65 deals saw a positive change in share price, 84 saw a negative change for the acquirer, with 4 share prices staying roughly the same. We're going to review some traditional valuation metrics, and right away we're going to say this analysis that these data points are very important in driving share prices for acquirers in the deals, but the data also proves that they aren't everything. They're not the only thing driving. In fact, there's not one key metric that we found that is the sole driver of share price reaction and has a perfect correlation. It was always possible to find a deal that bucked every trend. So what the data clearly showed us was that a combination of factors drove every share price reaction that we've seen in our data here. So we're going to start by looking at deals that looking at factors that correlated most strongly with share price reactions. And to do this, we're firstly going to look at just the 65 public company acquisitions in the data, just to show how closely a couple of the more traditional purchase price metrics correlate to share price movements. We've limited the analysis here to just public deals because the data we're using here would be 100% available for every single deal. We've collected it all in exactly the same way with exactly the same method, just to make sure everything is comparable across the database. So if you bring in private deals to this, you are reliant more on how a company reports the information to you, whereas with a public deal, we can go in and get the data in exactly the same way and guarantee its comparability. And while we could have chosen from any number of available metrics to show how closely deal value, so how expensive a purchase price may appear, correlate to share price movements, but we've chosen 2 of the most popular here. So we look at share premium on the left. So this is the percentage excess paid when comparing a purchase price on a per share basis of the target company to the actual current share price of the company. So how much more was paid in acquiring the company than the company is currently worth if you bought it on the stock exchange by yourself. And we're also looking at the EBITDA multiple, which is the number of years it will take for the purchase price of an acquisition to be covered by current or projected earnings of the target. So as we expected when starting this research, these 2 charts do show good correlation with share price movements. In that each data point here on the graph that we're showing represents one deal again. And the red trend lines on both go from the top left to bottom right. So that's indicating on the left-hand side that the lower the share premium, the better the immediate share price reaction has tended to be across the entire 10-year time frame. While the chart on the right similarly indicates that the smaller the EBITDA value, the better the share price reaction has typically been. So on the right-hand side, we can kind of see that the EBITDA correlation is not as strong as the share premium one. The line is a little bit flatter. But if you keep your eye on this chart, I'm about to change it and remove all deals conducted during the COVID years on the right-hand side. So here we see a much stronger correlation from top left to bottom right with the trend line. This suggests that earnings were not thought of as very important during the COVID time, not representative of long-term valuation of the target company. And because of that, share price reactions were behaving far more independently from this metric than we've seen in the other 8 years of our research here. So from these 2 charts, we can confidently state that traditional deal purchase price metrics, so any indication of how expensive a given deal is, do a lot to drive share price reactions. And as I said, we expected that at the outset. But the data also shows they're not perfectly correlating. So on the EBITDA chart, for example, we can see some clear outliers, and I'll just highlight them now in the bottom left quadrant. So these are deals with a low EBITDA multiple, but negative share price reactions. So while they have a strong correlation, this just goes to show that not all deals behave in the same way. And deal valuation metrics aren't everything driving share price reaction. So for the next section of the data, we're going to go back to looking at all 153 deals again, and to bring private company acquisitions back into the data. And first of all, we're going to examine how important it is for share price reactions to be acquiring in an existing basin of operations. So on this chart, which is the same chart as I showed earlier, we'd be showing many variations of it. This time we split the data between acquiring assets in an existing area of operations compared to acquiring assets in a new area of operations. So the dark blue ones are the new areas and the light blue are existing area of operations. So we're looking at this now because the outliers I just mentioned in the EBITDA chart, nearly all of those deals were companies acquiring other companies that were active in new basins for the acquiring company. So looking at this chart by itself, the data does not show that buying in your own basin or an existing basin is a guarantee of a positive share price reaction. We can see deals on both sides of the spectrum here. But it does show that buying into a new basin has generated significantly more negative immediate reactions than positive. Only 7 of the 28 out of basin acquisitions generated a positive reaction. And this does make sense, and it probably links back to deal valuation metrics quite closely in that if you're going into a new basin, integrating the acquired assets into your portfolio is probably going to take a little bit longer, and you might need to rely a lot more on target company expertise. So retain staff, retain equipment, things like that. So that might make cost reductions that usually come with getting a bigger organization in the same basin a little bit harder to realize as you're moving across 2 or 3 or more basins. And away from looking at the valuation, you could argue that buying out of basin can be seen as quite a sudden shift in strategy, and that might be quite jarring for investors. And you're relying more on how the deal is being communicated by management to dictate how the market reacts to it. And equally, as it's a new basin, new investors might be a bit more skeptical of any benefits or upside and think more along the lines of, I'll believe it when I see it and I'll reward you then. So all of this sort of combines to explain quite logically why on the right-hand side we have more darker blue bars for the deals that are acquiring assets in new areas of operations. And again, just to be clear, we're not saying that these deals are bad deals. We're just saying that the immediate one-day reaction has gone this way, and we're identifying the thinking behind why it appears that's to be the case. But as I say, there'll always be deals that buck the prevailing trend, and I'll quickly highlight one now. So this deal happened in 2018. It saw Cosmos Energy acquire Deep Gulf Energy, and it meant that Cosmos Energy was entering the Gulf of Mexico, having been previously focused on offshore African developments. This saw a 5% increase in Cosmos share price, despite being on the other side of the Atlantic Ocean. But here we don't just have the new basin factor to consider. On the face of it, this deal is being made to acquire a large existing producer in a very well-developed area with established infrastructure, which can't really be said for where Cosmos was operating before, as well as it was maybe doing in the offshore Africa. You're moving into the Gulf of Mexico. And equally, it's a US headquartered company with US investors, suddenly now active in arguably the most famous US producing area of them all. And the deal fits with the company's offshore development strategy, even if it is across the other side of the ocean. And equally, during the deal announcement, Cosmos was quite heavy on making sure it was clear that geologically speaking, they were similar asset bases. So while buying into a new basin seems to be generally unpopular one day after the deal being announced in this analysis, a combination of other factors can trump that pure one thing, again, proving that no one metric is a perfect correlation. Doesn't have to go that way every single time. So the next deal characteristic we're going to cover is something else that seems to tie back in part to deal valuation to explain its strong correlation, and that is acquiring private companies. So we quickly changed the parameters on the original chart. we're now separating the light blue and dark blue between acquiring privately owned companies in light blue to acquiring public companies in dark blue. And we see an immediate difference between the two in that 55% of the private company acquisitions received a positive reaction one day after the deal was announced, and only 28% of the public deals got a similar reaction. We do want to point out that the private deals are no doubt boosted by one trend we've already covered. So because a lot of them were acquisitions in existing basin of operations for the acquirer, so they weren't harmed by anything associated to new basin acquisitions that we've just covered. But there's also a common perception out there that acquiring a private company tends to be cheaper than taking a big public company off the market. So we decided to see if we could use our data to see if that was true. And then if it is, does that feed into a role in driving positive private company acquisition reactions in our data here? So to try and show this, we've used the cost per flowing barrel for every acquisition. So how much did the purchase price suggest was being paid for every barrel of current production of the target company? And we've plotted this cost against the oil weighting of the acquired company. So how much oil relative to gas it produces. So if we just plot the public company acquisitions to begin with, here in yellow, each dot again is on the chart is one deal, and the trend line shows the trend over the 10-year time frame. And the trend is, as we expected to see, the higher your oil weighting relative to gas, the more is paid per flowing barrel to acquire your company. So this makes sense because I say we expected that. It makes sense because oil production generates a higher profit margin per barrel than natural gas does on a pure operating revenue minus operating cost level. So you'd expect the costs of deals to follow this pattern too. So we're now going to switch to show private company deals. And again, we see the same trend in green this time, same data, every deal is one dot. The line goes up from bottom left to top right, suggesting again that the more oil you have in your portfolio relative to gas, the more it will cost to buy your company. So now we're going to plot the two charts together, and we see an interesting trend, which links back to the original question. So the green trend line for private company deals sits higher than the line for public companies. So this indicates that North American oil and gas producers have been able to buy higher oil-weighted assets at a lower cost per barrel on average when the target company is private over the past 10 years. Obviously, this is just one point of analysis, price versus oil weighting. It doesn't take things into account, like how accretive a deal may be, the cost base of the acquired assets, how developed the assets are, how much drilling's required to reach the upside that is being communicated by management. But it is one data point that can help feed the idea that perhaps buying private companies, you get a good value deal, which might be part of what's fueling the private company deals getting a bigger boost in share price reactions on the first day of the deal having occurred. So the data here is so far, with all the strong correlations we've shown, purchase price metrics and anything that can be attributed back to how expensive a deal appears to be, does a lot to drive these one-day share price reactions. So as I say, we've seen strong correlations of everything we've seen so far. So we're now going to move on to something that has changed over time when it comes to how it impacts share prices. And importantly, this time, this is totally unrelated to deal value. And it all revolves around deal structure. So for this data, we're again looking at using all 153 deals, including private, over the full 10-year time frame. And we're looking specifically at how the deal was paid for. Was it paid in cash? Was it paid in stock? Or was it a combination of both? So we've quickly plotted all deals back on the original chart. And we've got deals that included cash in the light blue and deals that were cash-free and stock-based in the dark blue. So from this chart by itself, we see no immediate correlation. So we decided to dig a little deeper and look at things over time to see if they'd changed. And here we can see a much clearer trend as we move on to the next slide. So we've split things up into 4 time periods. two pre-COVID periods. We've got 2014 to 16, 2017 to 19. Then we've got COVID as its own period in 20 and 21. And then we've got from 2022 through till the end of August this year as our final period. So as time moved on, the chart on the left-hand side shows that cash is becoming more and more prevalent in deals with negative reactions, while the right-hand chart shows that cash-free stock-based deals have switched from being by far the least popular way to complete a corporate merger on pre-COVID to generating far more positive reactions since. So this is having a clear impact despite being totally unrelated to any of the deal valuation metrics we've looked at earlier. So if you acquire a company for $10 billion, we'll have the same cost per barrel, the same EBITDA multiples, the same share premiums, whether it's paid for 100% cash or 100% stock-based. We believe this change in attitude is actually due towards, it's caused by changing cash spending patterns across the industry. And to show this, we're going to use data from our corporate financial and operating database. So we've taken cash usage data for the 88 public companies currently active in Q2 2024 with production of over 5,000 barrels per day in the US and Canada. So the chart here shows capex, debt repayment, and dividends and buybacks as percentages of total cash being used. And it shows, if I highlight the section of it now, that the capex makes up a very large portion of spending across North America pre-COVID. As we get to COVID in 2020, we see capex fall quite dramatically and a quick spike in debt repayments. And then after COVID in 2022, we see a gradual but significant climb in shareholder returns through dividends and buybacks. Capex also climbs up gradually again in 2022 and onwards, but we're still seeing it being a long way short of pre-COVID capex levels relative to other cash use. So how does this relate back to cash-based M&A deals seeing more negative reactions in recent years? So pre-COVID, from this chart here, we can see that around 50 to 70% of cash use was targeted at growth through capex spending. Cash-based M&A at this point was just an alternative, equivalent strategy to reach the same goal. Either you're spending on drilling or you're buying production in, as we to grow that way. What this new data now is showing is that when you compare that to now, the data on the chart here shows almost 70% of our group of 88 companies is now paying dividends, and over half are buying back shares compared to much, much lower figures in the past. So it shows that things have changed. We're not spending nearly all of our cash on capex anymore. We're spending on both capex and shareholder returns with reasonably equal priority. And our share price analysis suggests on the M&A deals that investors are clearly happier right now if cash is available to continue today's levels of dividend spending and buybacks instead of spending on M&A. It'll be interesting to see how this develops over time as more or less cash becomes available for this kind of spending, which one will take a back seat if cash comes down, and if they both grow, if cash goes up. So I'll quickly finish my section of this presentation to show a couple of charts that display a relatively weak level of correlation for two things that we were quite surprised by because they're mentioned in nearly every piece of deal analysis we've seen while doing this research for every deal that's mentioned. These two things were the oil price at the time a deal was agreed and how much debt was involved in acquisitions. So both showed very, very little correlation with share price movements. So the chart at the top plots the oil price at the time of each deal. So again, each dot on the chart represents one deal, plotted against the one-day share price reaction. And you can see here the trend line's almost flat, which indicates that the oil price itself is not enough to cause a reaction of any kind in the market. Of course, the oil price at the time of the deal may dictate how a acquirer behaves in terms of how much the deal's worth, how much they pay in cash, how much they pay in stock. But the simple act of buying in a down market did not always generate a negative reaction or didn't always generate a positive reaction. We saw a similar trend when looking at debt. We pulled the debt data out of the system in many, many different ways. I've provided one chart here, but there are many different ways of looking at this that all generated very, very little correlation with share price movement. We can see here that debt-free deals were just as positively received as deals that were very, very heavily debt laden. And there was no deal difference as we moved across the charts. So just as a quick conclusion and recap of the 10-year timeframe data that we were looking at, we saw strong correlation to share price movements for purchase price metrics and anything related to deal value that we could see in terms of the two examples we gave were buying in a new basin and buying in a private company. We saw a change in correlation to share price movements for cash-based deals, which were seeing greater levels of negative reactions post-COVID. And we saw a weak correlation to share price movements looking at oil price and target company debt position. So that's the end of the analysis on the 10-year timeframe we were looking at. And now Nikki's going to quickly cover what we think might be interesting to look at next.
Thanks for that, Mark. So that was an excellent overview of key influences over the past 10 years. We've seen that historical performance has shown that investor and market reactions can change over time and is dependent on many external factors. But which factors might grow in importance over the years to come? Well, we think that there are at least two more key factors which may influence market reactions in future to watch out for. The first one, a change in oil to gas ratio by buying more gas-weighted assets, could see gas producers gain relatively greater profit margins than in earlier decades due to increasing LNG export capacity across the US and Canada. And secondly, with the ever-increasing need for emissions reporting requirements, access to this data and better transparency will surely have an impact on M&A valuations and market reactions. We will, of course, be tracking this evolution through our data and insights, so keep up with us. How can we help you with tracking these future developments? Well, Evaluate Energy tracks corporate emissions data, and you can find asset level information in our other geologic products. Our corporate, financial, and operating and M&A databases contain comprehensive data. Mark has just given us a small glimpse of this subset of the data set in today's webinar. So that concludes today's webinar. As Jennifer mentioned at the beginning, you will receive a recording of this and a full report PDF that this presentation was based on in due course. If you want to find out more about Evaluate Energy, feel free to sign up to our newsletter, our insights pages, or look us up on LinkedIn. And the same if you are interested in discovering more solutions from Geologic, feel free to visit either of our websites. And that brings us to the end. So let's see if there are any questions for us to take. No questions just yet, but there was one that was sent in advance. So there was a question about where the tourmaline and crude deal fits into all of this. Could you speak to that?
Yeah, sure. So with that deal closing last week, I had quite a good look at it in preparation for this. So that deal saw a 5% boost in tourmaline share price, and it fit all the criteria we had in terms of it was in a existing basin of operations for tourmaline. Might not have been their core area, but it was in an area they were already operating. It was cash free, so again fits nicely with what we were saying earlier. The only metric it didn't match with, and it was quite an outlier in this regard, was the share premium, because they paid a 71%, 72% share premium on crude share price. And that is actually what the top or second highest share premium we saw in the data. And that chart showed that the lower the share premium, the better, but across the whole period. But I think, like I said, oftentimes a combination of factors will come together to generate a share price reaction. And while that one point was a outlier, tourmaline actually appeared in the data another 5 or 6 times. and only one deal they had the entire time period over the 10 years was a negative reaction. So clearly they've got M&A built into their strategy when the opportunity occurs. They've built up a lot of trust with their shareholders to the point where a 71% share premium really wasn't thought of as important to knock the at that time.
Thank you for that, Mark. No other questions just yet. Maybe you'd like to elaborate on why we chose the 1 day share price reaction rather than, say, 1 week or a month.
Yeah, so that we wanted to make sure as much as possible that the deal happening was having as much impact as it possibly could, and that it was actually going to be a comparable impact on share prices. The further we went from that 1 day reaction, the more it became apparent that other things could skew the analysis slightly. So, for example, we had 1/3 of the deals where the oil price was changing by more or less than 10% within a 28-day period for each of those deals. So there's no way we can legitimately bring those deals into a immediate share price reaction analysis when the oil price was changing so much. So sticking to 1 day meant we had a bigger database to work with, so we didn't have to rule out any deals like that. And we had the most comparable data possible for doing the analysis with.
Thank you. There's another question from one of our attendees. Is there any correlation with acquiring assets in a new country or continent as an extension of the correlation with buying out of basin that was discussed earlier?
So we haven't looked too hard at that because we were focused on North American deals, and 99% of them it was US or Canadian based companies acquiring US or Canadian assets. There were a few deals in data, so Cosmos being one of them, where a previously should we say a non-domestic focused company decided to buy back into its home country. There were a couple more that Gran Tierra i3 springs to mind, which previously a South American company that was a South American focused company that suddenly has bought Canadian assets. But with such a small amount of deals to work with, it was hard to draw any more conclusions to that, because there aren't many that have done that kind of deal.
Okay, thank you for that, Matt. There is one more question, slightly more hypothetical. So not really in the scope of the analysis done in today's webinar, but the question is, what's your team's assessment of why there haven't been many or any deals where a US-based operator buys a Canadian one to lengthen their inventory? Instead, Chevron, for example, is exiting the country. Any thoughts on that? Maybe one for a future insight.
For a future webinar, yeah. Yeah, I don't know off the top of my head. I'm not sure of that one, but it might be one to get back to the personal.
Yeah, so we will look into that, and feel free to email us at energyinfo@evaluateenergy.com any of the questions that you have, either now or subsequent to this webinar. If you're watching back on the recording and you do have any questions, feel free to email us, and we'd be happy to get back to you and talk you through it as well. Mark, we have one other question relating to the methodology of calculating cost per flowing barrel.
Sure. So you would take so in this case, the enterprise value of the deal. So you take the cash being paid for the company, the stock being issued for the company, and value that. You'd add the debt position of the company you're acquiring, and you divide all that by the target company's production level. Either you take the projected volume, if that's what's provided to you in a private company, or you take the most recent production figure that you've got, and you just divide it by that, and then that's the cost per flowing barrel. So the amount of the dollars being paid for every barrel of production that's coming out. So And then we plotted that in the chart against the oil weighting of the production being acquired, and it gave that we could see that oil weighted production was more expensive than gas weighted production.
Thank you for that, Mark. And to the attendee who posed that question, again, if you'd like to email us, we can, we're happy to walk you through that. Or
we actually have a PDF document that explains that metric and a couple of other key M&A analysis metrics that we could share. So yeah, like I said, if you get in touch, we can send you the link to download that.
Thank you. Do we have any other questions? Don't see any other questions for now. So thank you for your time today. Thank you for listening. And like I said, if you do have any questions, feel free to email us. That's energyinfo@evaluateenergy.com, or feel free to visit us at info.evaluateenergy.com, or use the QR code. And yeah, sign up to our newsletter for lots more insights and our regular newsletter. Thank you for your time today, everybody. Take care. Bye-bye.